Artificial intelligence is changing the stock market faster than most people realize. This week clearly showed one thing. We are no longer in the early stage of AI. We're entering the phase where real money, real risks, and real consequences start to matter. From massive investments to rising uncertainty on the market. Here's everything that happened this week. This week, global investors focused heavily on the real, tangible cost of artificial intelligence. It is no longer just a trend. Training a single advanced AI model can cost anywhere between $50 million and over $100 million today. Top tech companies are now spending billions annually on AI infrastructure, betting their entire future on these massive digital brains. For example, modern data centers cost hundreds of millions each, requiring massive amounts of energy and sophisticated cooling systems. High-end GPUs can cost between $20,000 and $40,000 per unit, and their value is only increasing. Large-scale deployments require tens of thousands of them, creating a massive barrier to entry that only the largest corporations can cross. Then comes inference, the process of serving millions of users daily, which creates continuous and mounting operational costs every second. At the same time, revenue is still catching up. While adoption is high, the immediate financial returns are under intense scrutiny. Many AI products generate subscription income, but margins remain relatively low compared to the staggering infrastructure spending required. This creates a widening gap between investment and profitability, leaving the stock market in a state of cautious anticipation. As we enter this new phase of real money and real risk, the stock market is transforming faster than anyone realized. Stay with us as we dive deeper into the financial shift of the AI era. The revolution is only just beginning. Market behavior this week showed just how fast modern trading has become. Today, over 60 to 70% of total trading volume in major markets is driven by algorithmic systems, not humans. These systems don't think the way people do. They operate on predefined models, reacting instantly to incoming data. Execution speeds are now measured in milliseconds, often below 10 milliseconds per trade. To put that into perspective, a human reaction time is around 200 to 300 milliseconds. So, by the time an investor reads a headline, multiple trades have already been executed, and this has a direct impact on how the market behaves. Price discovery is no longer gradual, it happens almost instantly. As a result, we're seeing a structural shift in market dynamics. Intraday price swings have increased. Trades have already been executed, and this has a direct impact on how the market behaves. Price discovery is no longer gradual, it happens almost instantly. As a result, we're seeing a structural shift in market dynamics. Intraday price swings have increased, with assets moving 1 to 3% within minutes, sometimes even seconds. Liquidity is also becoming more fragmented. It can appear and disappear very quickly, depending on how algorithms respond. This creates short windows where prices move aggressively before stabilizing again. Another important factor is that many of these systems are connected to similar data sources and signals, which means they often react in the same direction at the same time. That amplifies market movements. Instead of smooth trends, we get sharp spikes and sudden drops. In technical terms, this leads to higher short-term volatility and more frequent micro-dislocations in price. This is no longer a slow, human-driven market. It's a high-speed, machine-driven system, where speed and execution efficiency define the outcome. And for slower participants, this creates a clear disadvantage. And that changes everything. Another key trend this week was capital rotation. Large-cap tech companies, despite strong fundamentals, are trading at high valuation multiples. Some of them are priced at 25x, 35x forward earnings. Meanwhile, smaller companies are often trading below 15x earnings. AI-driven models are identifying these valuation gaps and reallocating capital accordingly. We're seeing increased inflows into mid-cap and small-cap segments. In some cases, smaller stocks are outperforming large caps by 5 to 10% in short periods. Finally, this week highlighted growing systemic risks. AI systems rely on massive data inputs, including news, reports, and real-time sentiment. Even a small shift in information can trigger automated decisions across the market. Sentiment-driven trading models can see performance swings of 10 to 15% based on data quality. At scale, this creates a fragile system, because when algorithms react simultaneously, it amplifies market movements. This increases the risk of sudden drops, overreactions, and short-term mispricing. The more automated the market becomes, the more sensitive it is to information flow. The market is no longer just driven by fundamentals. It's driven by speed, data, and algorithms. And the numbers clearly show one thing: this transformation is already happening, and that changes everything.